I'm quite ignorant on this one. I understand on a primary residence, I don't have a capital gains tax. On investment property, I do have this capital gains tax. On the second home, the vacation property,
Yeah.
do you have a capital gains tax?
Yes, you would. So let me repeat the question and for the videotape as well. We're talking about a vacation home or a second home. So this is obviously not your personal primary residence. If you sell that vacation home, sell that second home, you're gonna have to pay the capital gains unless you've limited your personal use, limited it so much that you can now qualify using those 3 bullet points that I gave you, and you can do a 1031 exchange on it. Okay, let me just keep marching through the rules. Is this the right way that you want me to go through the rules? All right. So rule number 2 and rule number 3. You know what I'm gonna do? I'm just gonna let you read them for just a half second. So we're on that front page. By the way, rules 2 and 3 are talking about or referring to that little diagram that's in the middle of the page there. So I'll just be quiet for a second, let you read, and then can't help myself, I'll probably just start talking again. You know what, let's sort of dive into it, and I know you may not be completely finished, but let me just walk through it briefly. Rules 2 and 3 are basically telling us a couple of things. They're telling us, 1, when does the 1031 exchange start? So the answer is, it starts the day you close on the sale of the property. It does not start when you go under contract, or when you get an earnest money check from an interested buyer. It starts at the closing of the sale, meaning that we have to have documents prepared that the IRS wants. They have to be prepared and in place for the closing of the sale. So goodness, if you're sitting there at the closing sale and the client turns and looks at you and says, am I gonna get taxed on this? You need to tell them, yeah, it's gonna be how much? 30%, with 3 big fingers right in his face. No, don't do that. 30%, maybe as bad as 40%. And he says, well, I don't believe you. And you say, no, don't worry about it. It's the recapture of depreciation that's kicking everything up. And then put the closing on pause. We can probably get documents there in about 15 or maybe 20 minutes. Our record is 12 minutes, but let's not do that. I would like it, if this is the closing of the sale, contact us way before the closing even occurs. How far in advance of the sale closing should you call us? When you go under contract is a pretty good rule of thumb. And you don't have to do very much. Just call us up and say, hey Tracy, I'm under contract. It's gonna be a fast closing sale, it's a cash buyer. We're gonna close in 23 days, fine. Just tell me who the title company is and tell me the address of the property you're selling. That's it. We'll do everything else for you, everything else for the client. We deal directly with the title insurance company to get this all done for you. So that's when does the exchange start. Now, the other thing that rules 2 and 3 do for us is tell us this. When you close on the sale and all of our documents are there and the exchange is now officially started, you're gonna get 45 days after that to simply identify the next property or properties that you might maybe want to buy or exchange into. The other timeline starts on the same day, the day you close on the sale, and you get 180 days to close on the purchase of one or more of those properties that you identify. So the 45 days and the 180 days are running at the same time, they're running concurrently. That's really pretty much all I want to talk about there, because in the interest of time, I'd sort of like to move on. Is that all right? So there's a...
One thing that I think is important to know for any of you, if you don't already, is that you can identify the properties even before the closing. So you don't have to wait till the day of closing. You can be looking, you can have simultaneous closings, you can do all these things, but that's just the maximum time. But it's always important.
Before the closing of the sale, you identify what it is you might be able to buy. You can actually go under contract put earnest money down on a possible new replacement property. Okay, rule number 4. You know what I'd like you to do? In the margins, write this down. This is Tracy's favorite rule. Write that down. Because basically, the 3 bullet points underneath number 4 say the following. 1, you have to use a qualified intermediary. You cannot do an exchange without us. It's required by law. I like this rule. Bullet point number 2 says, hey, the client is not going to be able to use their own attorney or their accountant to do the exchange. They can, of course, get tax or legal advice, but they cannot do the exchange. So this is shaping up to be like my most favorite rule. So you gotta use me, they can't use their accountant or their attorney, and bullet point number 3, underneath number 4 here, says the following. Normally, you're sitting there at the closing table of the sale, and what does your client walk out of the room, the investor, the seller? Nice big proceeds check. That cannot happen in a 1031. Instead, those monies must be wired from the closing table to us, IBX, and by law, we have to hold on to those monies until they're ready to close on the purchase of that next replacement property. So they gotta use me, they can't use accountant, and I get to hold the money. This is a sweet rule, I like this. Now, let me tell you something about our business. It is not regulated. There's no licensing. The 1031 world is like the wild, wild west. In Colorado, we've had 7 or more qualified intermediaries that have taken the clients' monies, embezzled them. And then the clients are left holding the bag and they cannot finish their 1031 exchange. So, goodness, you've got to use me. I get to hold the money. Are you feeling warm and fuzzy right now? Probably not. So, what do we do to protect you? There's a whole bunch of information. I'd like you to turn your handouts over to the back side and look at the top bigger box. Again, a whole lot of bullet points there, but let me emphasize a couple of things. Every single 1031 exchange that we do has a fidelity bond of at least $100 million on it. We also guarantee the performance of the exchange. No other company does that. We guarantee the performance up to $50 million. A couple other bullet points, maybe you put stars or an asterisk next to them. We hold your exchange proceeds in separate, segregated accounts, separate from our firm's operating assets, segregated from any other client's 1031 monies. One more step, we actually put the client's name on the exchange account, so that if something goes wrong, the client just has to walk in the bank with their driver's license and say, hey, that money's mine. So we use separate, segregated accounts with the client's name on there. We're bonded, performance guarantee. What else do you need to know? Is the bank in Haiti. We actually use a portfolio of banks. There's about 13 or 14 different banks. They're all FDIC insured. Let me give you some of the names. Citicorp, Wells Fargo, TCF, Union Bank of California, help me out, anybody else? US Bank, sometimes JP Morgan, there's others I'm forgetting. Every single bank is reviewed quarterly by Fidelity's Corporate Treasury Department. All accounts are reconciled daily, and our auditor is KPMG, one of the big 4. So they're not in Haiti. Okay. What else do I need to know here? Yep.
Does all the money have to go into the 1031 exchange, or can you keep some back to pay?
Yeah, so you're sort of moving on to the next rule, which is rule number 5. If that's okay, that's where I'd like to go. You betcha. Rule number 5. So now let me just read that to you. To pay 0 taxes, to fully defer all of the gains, you gotta buy, exchange into replacement property that is equal or greater in value. Let's just stop right there. Do yourselves a favor, just put an underline or a circle around equal or greater in value. That is the entire tax code in about 3 or 4 or 5 words. And then I'm gonna do something with my hands. If you sell the old property for this much, whatever it is, maybe it's the $300,000 rental contract, fine, you sold it. To fully defer your gains, you've gotta go buy another property that is equal or greater in value. So if you sold for 300, you buy for 300, you're fine. If you sell for 300 and you buy for 400, you're fine. If you sell for 300 and you buy something that's worth only like 250, are you gonna be okay? I says, yeah, well, the difference, the amount that you have bought down, that part only will be subject to capital gains recognition. It's called boot. So the $50,000 would be hit with that 30%, that's about 15 grand in taxes, but you can do that. But the moral of the story, if you're a real estate agent, is what? Don't let them buy a property that's less expensive, or have them buy 2 properties. You can sell one and exchange into multiple replacement properties. In fact, you can even do the opposite. You have someone that's selling 2 or 3 or 4 more properties, can they moosh them all together and go buy one bigger, larger, more expensive property? They can do that. They can do any combination. Back to the rule. To pay 0 taxes, you're gonna buy a replacement property that's equal or greater in value, and I even capitalize that word "and," because it is a 2-part rule. And you must reinvest all of the cash proceeds. Let's do an example. You're selling the $300,000 condo. I'm gonna ignore commissions and closing costs for a moment, okay? You sell the $300,000 condo, and there's a $200,000 mortgage on the property. So how much cash is there after everything's said and done? 100 grand, which is supposed to come to us, IPX. We hold on to it until they're ready to go buy the next property. Is everybody walking with me? Cool. What do clients usually say? I've owned that damn rental condo now for 7 years, and I want some of my money out of there. Can I get a little bit of my money out there? I need 12 grand for whatever reason, to pay off some credit card bills or something. Can they keep or pull out some of the money at the closing of the sale? The answer is, yeah. But they have to what? Pay taxes on it. Again, by pulling or touching some of the cash, pulling out or touching some of the cash, it is boot. So you get boot in a couple of ways, by buying less in value or by pulling out some of the cash. So this is a nifty little trick, if that's okay. I want to give it to you. Client says, I want some of the money, but then you're telling me, Tracy, I'm gonna get taxed on it? Yeah. So here's the deal. He sells, keep all the money in the exchange, reinvest it, and once he's bought the new replacement property and the exchange is done and over, the very next day, he can pull out the 12 grand that he wanted, and there are no taxes. That's a pretty cool trick. We're all good? You had a question, Greg?
Yeah, the question is can you spend some of the proceeds on the expenses of the transaction? So if you have legal fees for 10 grand or whatever.
Yeah,
Can I
let's do
spend
that.
it on that?
Yep, so here's each question. You're gonna sell the property for $300,000, and I'm gonna sort of tweak your question a little bit. If you sell for 300, I just told you gotta go buy some other property or properties that are at least equal 300,000 or more to have no taxes. But really, it's not 300,000. You get to skinny the number down. The 2 things you're allowed to subtract are commissions and the closing costs, like title insurance and whatnot. So maybe the $300,000 number really works its way down to more like 285. But again, you have to leave the debt in there. So now your equal up is not 300,000, it's more like 285, so you buy 285, equal or greater. His question was a little more sophisticated. What about legal fees? What if this is a $3 million piece of property, you have a bunch of attorneys that are involved, as long as those legal fees, even if they come in after the closing of the sale, as long as those attorneys' fees, even if they're on retainer, pertain to that subject property, it's okay to subtract them out. Good question. Yeah.
You could get a HELOC on that property before you even sell it and pull the cash
Oh,
out
I like
before.
that. That's a great question. Let me repeat it for everybody and the video. So this property, and you're not supposed to take the cash on, or if you do, you're gonna get hit with taxes. Why don't you just suck the money out 2 or 3 or 4 months ahead of time with a HELOC or something like that? The guy says, wow, you did that? You went around Tracy's favorite rule, number 4, and they're gonna probably make you pay the capital gains tax on it. So try not to refinance. Well, you could refinance how far in advance of the sale? At least a year and a day. Then you'd be okay. That's why the trick of refinancing on the new property is probably a better method.
Not to be sneaky, but how does that come out? Like, how does anybody know that you did that refinance 6 months ago? Just from the age of that
Well,
note?
that is a great question. She's really asking, how is the IRS gonna catch you? That's bottom line what she's asking. The answer is, it may not be very apparent. But if they do audit you, and they find out, just let's not go there. Yeah, the burden of proof is always on you. All right. Yep,
You have a loan on the property you're disposing of.
Yes.
IRS doesn't care. It's the gross sales price against gross purchase price.
correct. Or gross less commissions and
Right,
closing
right.
costs, yes.
So you have.
Everybody
to
hear what
find a
he's
way to
asking? Yeah.
replace that loan in some way, shape, or form, either with a new loan.
Or more of your own cash.
Your own money.
Yep, let's go through that to make sure we're covering it. So let's go back and use the numbers. We're selling for 300 grand. And you take out the commissions and the closing costs, and now we've gotten from 300 down to about 285, okay? Now, there's a loan on the property of 200,000. So how much cash is there gonna be? About 85 grand, which we are supposed to hang on to until they're ready to go buy the new next replacement property. So clients will wrestle with this thing, this idea, and they'll say, I just paid off Wells Fargo, or I paid off US Bank on the sale. Why can't I just do the exchange for the amount of my cash, 85,000? What gives? Why are you telling me, Tracy, that I'm gonna go buy another property that's $285,000 or more in value? Because of this concept. The first dollars that come out of a sale are always considered to be capital gains. So the extinguishment of debt, you've got to replace the debt, or you can use more of your own money. Let's go through that. You sell for 300, you whittle it down to 285, pay off the mortgage of 200,000, you got 85 grand in cash. You go buy another property, that happens to be the same price, 285,000. Isn't that nifty how that works out? Buy the same property, so you only got 85 grand, you wanna buy something that's 285, where are you gonna get the 200,000? Most people go and get another loan, but you don't have to. Replacing the debt on the new property with the same amount of debt that you had on the old property is not a requirement per se. If you don't want to get another loan for 200 grand, you'd rather only get a loan for 150,000 and put in 50 grand of your own money, you can do that. So you can replace debt with your own equity. Cool. There's another question that clients will ask. Besides paying off the loan, they'll go through this little mental gymnastics. So we're selling that $300,000 condo. Everybody with me still? And years ago, when they bought the property, they bought it for, I'm gonna make it up, 200,000. And back years and years ago, when they bought it, they put 50 grand of their own money into it, and they got a loan for 150,000. Everybody with me? And now today, when they sell it, I'm telling them, for them to do the exchange, pay no tax, to defer all the gains, they gotta go buy something that's equal or greater, and the guy says to me, I want my original $50,000 out. That's my money, that's my principal. I already paid taxes on it when I first invested this thing. How come I can't get it out? What's the concept? The first dollars out of the sale are always considered to be capital gains, that's what. All right, Rocky.
Is your fee also subject to,
I love Rocky.
I'm a client.
You are, yeah, whatever. Cost me a lot in Starbucks cards, but okay. So, our fee, first of all, our fee is $950. So, good and cheap. It covers all the documents for the sale, all the documents for the purchase. The $950 is a selling expense. In other words, it comes out just like commissions and closing costs and whatnot. The other thing you want to remember when you're talking to a client, or even for your own self, is the $950 is a tax deductible item. You can either expense it, or you can capitalize it on the base of the property. Thank you. All right, how much more time do I have, Linda? I
About
got
another 15 minutes.
15?
I mean,
15 minutes.
we'd
okay.
love to have you
Okay.
talk
All right.
and take questions.
The
Okay.
950 comes off of the sale or the purchase?
Sale. Because we do our work up front.
Okay, quick question is that you're getting to the end where you're retiring and you want to unwind all this.
Yep, that's my tax-free exit strategy. That's my big finale. That's how I get out of the room safely tonight.
Okay. well, let's-
Yeah.
let's-
I gotta hold you up. Thank you. Don't steal my thunder. All right, so we're done with rule number 5. Rule number 6. Yep, Linda?
Can I ask a quick question? So I just did a 1031 into the place up in Grand Lake. the people took all of their furniture, so I just spent $30,000 on furnishing it. So when I do something,
Actually, it's a good point. I
the
didn't
next,
go through that, and I think I should do that.
yeah,
So client's selling the property, and to get it ready for sale, they're gonna spend, I don't know, make up a number, they're gonna spend $13,000. They gotta paint the place, put in some new carpet, fix up the window treatment, the furnishings, you know, the drapes and whatnot. So they're gonna spend that money. Usually they'll ask me at the closing of the sale, or maybe a couple days before, hey, the 13 grand I spent to fix this dump up, I want to, that was supposed to be funny, but okay. Don't I get paid the $13,000? If you actually show the 13 grand on the settlement statement, in all likelihood, the IRS, if they catch it, are gonna say that it is what? Capital gains. First dollars coming out are always considered to be gain. So the clients you'd like mystified, like, how am I gonna get my money back? You're probably gonna have to take it on your Schedule E as an expense. Otherwise, you can try and capitalize it, but that'd be sort of an accountant's call on whether or not you can capitalize it to the base. But that's, okay, good, thank you, Linda. All right, now I'm ready for rule number 6, yeah?
How much exit strategy?
Yep, no, I gotta get the last rule first, then we'll do the exit strategy. And then opportunity zones. We gotta line these things up. All right, last rule, and you know what I want you to do is take a look at the first bullet point underneath number 6. And it says tax return trumps title. Nothing to do with the president, just to settle everybody down. Tax return trumps, it means simply this, that the tax return, how the client's been treating that property on their tax return, is more important, is superior to the actual vesting of title. So can people that own real estate sell and do an exchange? Sure. Can a partnership, if I had these 3 people right here in a partnership, can they, if they own real estate, can they sell and do a 1031 exchange? In other words, all 3 of them go do a 1031 together. Sure. Same thing for LLCs or trusts or even corporations, either sub S or C corporations. But there's one little place in the tax code, to make this example short, that gives us a little bit of fits in the 1031 industry, and that's married filing joint. Who's married in here? Great, let me see hands. Greg and, no, let me pick on you, Cindy, and, is that Bobby? You guys are, okay. So Cindy and Bobby, let's just, gotta be careful when I get them both in the room at the same time. Cindy owns the old property. It's gonna be that rental condo we've been harping on, and you're gonna sell it for 300 grand. But for some reason, you never bothered to put Bobby on title. I mean, it's a condo left over from your swinging college days or something. Okay, so you think to yourself, hey, we're married, filing joint. I'm just gonna do a quick claim and get Bobby onto the title. Now we're both together like we should be, and we go do the exchange together, because that's how our tax return is, married, filing joint. The tax return is superior to title, but not with married people. If it's just Cindy, and she adds Bobby to the title before she sells and does a 1031, she'll have fatally damaged her exchange. You can't change the vesting of title immediately before the sale and the 1031. Wow, so we cannot add Bobby. So Cindy just sells, she does exchange, she buys the new property, whatever the heck it is you're gonna buy. Now the dust is settled, the ink is dry, your exchange is over. Now you can add Bobby to the title. No. She has to wait how long? At least a year and a day. Yeah. So Cindy is safe with the IRS, but her marriage is in jeopardy. So we can't add Bobby here. She has to sell, she has to do the exchange. Wait, what are we selling, the $300,000 condo? So what we're doing is buying a property that's greater, let's say it's $400,000. Well, what is Cindy's minimum dollar amount that she has to end up buying to satisfy the exchange, to fully defer all the gain?
300.
Yeah, she only needs to own how much of the new property? Just 300 grand. She's a 75% tenant common owner. The other 100,000 or 25% tenant common could be who? Bobby. Maybe a boyfriend, whatever she's got going on. And then they have to be tenant common for at least how long? A year and a day. Then they become joint tenants.
What if Cindy can't afford the new place on her own and she needs Bobby on the loan?
Well, if it's more valuable, then we can squeeze Bobby on for 100 grand. Maybe that's good enough for the lender. They'll say, oh, it's only gonna be that way for a year anyway. That might be good enough.
You can't break up the loan that way.
It-
You mean like getting a loan just for 100,000 separate?
Yeah, or the underwriter may say, I'm still willing to lend you 400, or whatever it takes to buy the $400,000 property, even if Bobby doesn't own half of it because he's married, filing joint, maybe only owns 25%. You gotta emphasize to the lender, it's only gonna be that way for a year to satisfy the exchange, and then it can be joint tenants.
So would
If the
they take
lender
it as
still-
tenants in
the lender
common
still
then?
gives you fits, then I would suggest the following, go get another lender. There's plenty of people out there with money. So I wanna make sure she got that, but I don't know. Linda?
Would you take that as tenants in common then? 3/4 and 1/4?
Yeah,
Okay.
absolutely. Okay. Did you hear my advice about getting a new lender?
I'm sorry?
No, that's all right. If the lender truly won't loan, even on some sort of tenant common situation, go get another lender. There's lots of lenders out there that want to loan the money.
It's a Fannie Freddie Mac thing as far as you can't divide the loan and say you're qualifying for this amount, but you're qualifying for that amount. But we were talking about, you don't have to be on title if you're on the loan. So can Bobby be on the loan and just not on title? 'Cause in
Sure,
my case, it's
absolutely.
credit.
But boy, if I was a lender and he wasn't actually on title, what do I have?
Well, but Cindy's on
Mhm.
title, so she's on
So
the
she's
loan.
got the risk.
Yeah,
You've
okay.
got two
Well, if the
parties.
lender's willing to do that, great.
Yeah, we get that, and, because sometimes they're, the other party does not have the credit. That would be as good to get the interest rates and such like that. So we do see that periodically. You're signing the deed, but not the note. if I remember
But we're
correctly.
talking about the opposite way.
Oh,
Yeah,
not,
should do the
yeah.
opposite, So now we're done with the business rules of the 1031 exchange. There's two things I want to go through. Three, actually. So I'm going to have to do this pretty dang fast. I want to talk to you just a smidgen about reverse 1031 exchanges, how to get out tax-free, and then opportunity zones. You asked about it. So here we go, let's go fast. I'm going to use my hands, so you're going to have to watch. I hate to say that. So you sell the old property, you got 45 days to identify, 180 days to get it done to buy the new property. What's your biggest challenge in today's market? Finding this. There's no inventory. Supply is very low. So a client says, well, can't I buy it first before I get the old one sold? Let's think about that. Client does that. They buy the new property. They're on title. They're still on title of the old one because they haven't closed on the sale yet. They're on title to both at the same time. Guy says, no, can't do an exchange between them because you own them both at the same time. So they created this little bit of fiction in the tax code called the reverse 1031 exchange. Rev Proc 2000-33, 36. And it goes like this. Instead of the client buying the new property, it's actually going to be us, IPX. We have to create a special purpose entity. That entity will step into the shoes of the client, and we will actually be the ones that will purchase their new property. It's called parking title. The day that we park title starts the reverse exchange, and they get 180 days to do what? To get the old property sold. Once they've got it sold, then all we do is transfer title from us to them, and that finishes the reverse exchange. In today's market, we're doing an awful lot of reverse exchanges because of the problem with inventory and supply. So reverse exchanges are not $950, they're more expensive, give or take, they're about $4,000. And they're just much, much more complex in terms of paperwork. So that was a quickie on reverse exchanges. Second thing we wanted to talk about was how to get out tax-free, right? Don't you want to get out tax-free? So let me just set the stage. If you do an exchange, or maybe you do 2 exchanges or even 3 exchanges, what's happening to your gain every time you do a 1031? It just keeps getting what? Bigger. And on the last piece of property, what's going to happen? You're going to have to pay the tax. Note, the gain will still get bigger, even if the real estate market goes down in the meantime, because of the recapture of depreciation. Okay. So on the last piece of property, you got this big old gain. So this is my big finale, although I'm going to have a little talk about opportunity zones. You might want to take notes. This is what I call a tax-free exit strategy. Tax-free exit strategy. Strategy number 1, in capital letters, write the word croak. Because if you die, there is a step up in basis. Section 1014 was preserved in the new tax code. Everything you own, all your stocks, your bonds, your mutual funds, your baseball card collection, your real estate investments, the original purchase price steps up to fair market value on the date of your death, and all these capital gains are vaporized. Your kids get the real estate, they sell it, they don't have to pay the capital gains taxes because there are no capital gains. That's pretty cool, but you only get to use it once. So is there another strategy that's a lot better? Yeah, there is, and I give it this name. Revenue Procedure 2005 was the year, Revenue Procedure 2005-14. And it goes like this. These are a bunch of bullet points. I don't know if you want to write them down or not. You can always shoot me an email, say, Tracy, you talk too fast. Please just send me the bullet points, but let's try and do it. So bullet point number 1, again, we're gonna do a magic trick on the last piece of property to pull out some or all of these gains tax-free. So when you exchange into this last piece of property, what type of real estate can you buy that you can exchange into? And the answer is any. Everybody with me? But not for the magic trick. It's gotta be something that's residential. It's gotta be a house, a condo, a townhome. You cannot do this magic trick on raw land or an industrial warehouse. That doesn't work. Bullet point number 2. So first bullet point was it's gotta be residential. Bullet point number 2, when you exchange into the property, how long should you own it? At least a day. Not for the magic. For the magic to happen, you must own it a minimum of 5 years. 5 years is your holding period for it. Bullet point number 3, if I'm counting right. For the first year of the 5 years, the first year that you own the last replacement property, you've got to rent it out. You've got to treat it as an investment. Or otherwise, the IRS says this whole thing was just a sham. They'll unwind the previous exchange, make you pay the tax. There is a safe harbor built in 2008, so that if you rent it out, not just 1 year, but rent it out for 2 years, the first 2 years, then this strategy is like bulletproof. After the first year, or after the first 2 years, you can now safely move into the property without endangering your previous 1031 exchange. By moving into it and living there at least 2 years, then later on when you sell it, guess what you get to use? Your personal home exclusion, and pull out your 250 grand if you're single, or 500,000 if you're married, filing joint. Everybody good? Everybody follow that? Now I need to give you 2 caveats. I had a millennial in a class the other day that looked at me and asked, what's a caveat? It's not going to go over well on Facebook. So caveat number 1. Remember, when we are doing 1031s, we're rolling 2 chunks of capital gains each time, over and over. The appreciation and the depreciation. And on this last piece of property, only the appreciation is coming out tax-free. The depreciation recapture, you're still going to have to pay the tax on. So it's not a completely tax-free exit strategy, but it's pretty good, because it beats dying. Now the other caveat is this. You don't get the full $500,000 anymore, you get some fraction. So how the heck do they figure out the fraction? The fraction is this. The numerator, the top number of the fraction, is the number of years or the number of months that you actually lived in the property. So in my example, we exchanged into it, I rented it because I like safe harbor. And then I lived there for 3 years, and then I sold it at the end of the 5th year. So my top number of the fraction would be 3 years of living in it, divided by the bottom number, the denominator, is the total number of years that you owned it. How many years did we own it? 5. So the fraction becomes 3/5. 3/5 of 500,000 is what? 300 grand. So now your exclusion, the amount that comes out tax-free, is 300,000 in my story, not the full 500. Right, we're done? Over? Yes, Mary?
So if you've owned it for, say, 15 years and rented it, and then you try and do this, your
Sure.
fraction's awfully small.
Well, it depends on how many years
If
you
you
live
lived
in
in
it.
it 3 years,
Oh, yeah, okay, so she's saying you exchange it to the property, and you own it not just for 5, but for 15 years, and how many years do you wanna live there?
after the 15 years, you.
So you're
you
gonna rent the
live there
place out for
another 3
15 years, and then move in there and live there?
Yeah,
You gotta live there at least 2. So now how many total years do we have? 15 plus 2, we got 17. 17 is the bottom number. And how many years did we live in it, top number? 2. So you're right, the fraction is pretty puny.
okay.
The idea here is not to rent out this property for a long time. The idea is to rent it out as little as possible, and then
So-
move into it.
So in other words, the
Sell that.
better approach would be to sell it and do another 1031 exchange and then do the 5-year thingy.
Sure.
What is the safe harbor? Why the second year? Why
Well,
can't it?
that safe harbor came out in Red Proc 2008-16, and it really was talking about vacation homes and second homes, but it's also applicable to this exit strategy. So they say, the IRS says, hey, if you rent this property out for 2 full taxable years, to us, that's very good at showing your intent to be a long-term investor. Therefore, we think it's valid.
But 1 year's just as good.
1 year, in my opinion, is probably just as good.
Okay.
But some people like to sleep with both eyes closed at night, so they'll rent it out for 2, and we're all good. All right, now I'm truly done, except for you wanted me to talk about opportunity zones. Not enterprise, opportunity zones. Yeah, okay, how many of you heard about opportunity zones? 2 of you have, okay. Well, this will be brief then, we'll do that. So, the new tax reform, Tax Cuts and Jobs Act, created I think, a pretty nifty little deal in there. It's brand new, they're called opportunity zones. Some people refer to them sort of tongue-in-cheek as O-zones, opportunity zones. And what they are geographically defined areas. Throughout the United States, there's like 8,700 and some odd opportunity zones. They were created by the governors of each state, and they are now carved in stone. There's not going to be any more. They're already defined. That's it. Well, 8,000 some opportunity zones. And what they are geographic areas that are economically distressed. The idea behind this part of the tax code was to take a bunch of unrealized capital gains, use those monies to get them to invest in economically challenged areas. So there are some estimates that Americans, we own stocks, we own bonds, we own mutual funds, we own investment real estate. And if you haven't sold them, you know, they've pretty much gone up in value. So the grand total of almost everything that Americans own, there's unrealized gains of about $2.3, $2.4 trillion. Okay, that's a lot of profit, a lot of capital gain. Wouldn't it be nice to incentivize investors to take some of those gains and go spend it on these economically challenged areas, opportunity zones? That's what this part of the tax code tries to do. Here's how it works. You can sell anything. You can sell real estate, but you could also sell stocks or bonds or a business or a partnership. You can sell anything, not just real estate. And then you can take the gain, not the basis. You can take the gain, the profit, and go invest it into the opportunity zone. There's a couple little wrinkles going on here. You have, from the date that you close on the sale, if it's real estate, or the date that you sell your stocks or bonds, you have 180 days to reinvest just the gain into the opportunity zone. Now that sounds a lot like the 180 days of a 1031. That's it. That's just, you happen to use the same number, 180. This is not a 1031 exchange. All right, another little wrinkle. You cannot actually take the gain and go buy something like a piece of real estate in the opportunity zone. You have to instead invest through an opportunity zone fund. The fund then invests in that geographic area. So how many funds are there? So far, there's several hundred of them, all self-certified. Also, if you want to have, you know, an idea of where these geographic opportunity zones are, send me an email and I'll give you a link. There's a nationwide map, you can click on it and you can find opportunity zones anywhere, everywhere. Colorado, Wyoming, Florida, wherever. All right, back to the story. Again, the idea is to take the game, invest it within 180 days into the Opportunity Zone Fund, and guess what? You've deferred the gain. You don't have to pay the capital gains taxes. That's a pretty nifty deal. Then they sweetened the pot. They said, okay, we'll let you defer the gain. And if you stay in this Opportunity Zone for at least 5 years, then 10% of your gain that you deferred comes out tax-free. In other words, the basis steps up by 10%. If you stay in the Opportunity Zone 7 years, they sweeten the pot even more. Then 15% of the capital gains come out tax-free. Let me do the math. If you have $100,000 of gain that you're investing in the O-Zone, and you hold it in the O-Zone for 5 years, then now you only have to pay tax not on 100, but only 90,000. If you hold it in there 7 years, you only have to pay tax on what? 85,000. Now they sweeten the pot even more. If you leave your investment in there for 10 whole years, then you don't get any more step up in basis. It's, you know, 15% is forgiven, tax-free. But any new gain, so you've been in this O-Zone long, how long now? 10 years. So all along, hopefully, if they've done it right, this O-Zone area has gotten better. It's more productive. So any new gain from being in the zone now comes out completely tax-free. That's a pretty nifty deal. So they're, again, what they're doing is trying to attract huge amounts of untapped capital gains, take them and invest it in economically challenged areas. So that's a real thumbnail overview of opportunity zones. I'm done. You done? Want any questions? Was that good?
Yes, that was very good.
Anybody else? All right.
And did a fantastic job. So, although he covered a lot in a short time, there's even more wrinkles and more details that you really need to address if you're going to do something like this, because timing is critical. So call Tracy or Davida, Danita, that's her name, and she'll talk to you about that. Just 4 things. For those of you that I manage properties for, I want you to know that I'm not retiring, because I get asked that all the time, because I love doing what I'm doing. I have a great team that helps me do what I do, and I like to help owners grow their portfolio and their property and investments. Secondly, for our owners that I manage for, please look at your monthly statement, look at the message on the top of the statement. That's one of the ways we communicate with our owners every month about something that's relative to what's going on, whether it's their property or the market or something we're going to be doing down the road. And then third, there was legislation passed in 2017, took effect January 1st of 2018 by the legislature that says all of our documents need to be prepared by attorneys, specifically property management and our leases. We've had attorneys draw in our leases and management agreements before, but that also now has to have a stamp on it that says this was prepared by an attorney. So we're going to be sending out new management agreements to all of you in the future here to comply with that legislation. And I think lastly, that's it. I hope you enjoyed the time. Tracy did a great job, and be careful driving. Thanks.